Peter. Welcome to 2020 Investments. Today, we are going to discuss how risky investing in ETFs is. While there are many considerations that go into establishing a fund's risk rating, in this presentation we shall only focus on investment risk.
Good morning, Susan. What do you mean by investment risk?
I mean the risk that the value of your portfolio will go down rather than up. To better understand this risk, one can consider a number of factors that drives future returns, but the simplest way to gain an insight into what might happen is to study the empirical data.
Isn't it dangerous looking at historical data to infer what might happen in the future?
In many ways, yes, but if the historical data covers a wide range of economic conditions, then we can at least get a feeling for the size of potential losses.
Okay, but why do analysts look at percentage returns rather than changes in the absolute level of the fund's net asset value?
Ultimately, one looks for a way of comparing the riskiness of ETFs on a like-for-like basis.
Surely, the price behavior of the riskiness of stocks and bonds is quite different.
They are, but because ETFs trade like stocks and can be bought or sold on an intraday basis, the process of computing the investment risk is almost identical. To understand what is meant by a 12% volatility, one studies the historical annual returns of the ETF. If the ETF was launched a long time ago, say 10 years, then it would be a simple matter to look at the year-on-year returns and just tabulate the 10 numbers.
More often than not, the amount of historical data will be much short than that.
Not surprisingly, the annual return varies according to the period at which one is looking. With that in mind, as one rolls the window of time backwards, one can learn a lot about the variability of future returns by observing how the annual performance varies.
Susan, can't one also look to see how variable the daily returns are? And given there are many more observations, one will glean a much better feel for their variability?
Exactly. It is this variability of the daily, monthly, or annual returns that gives rise to the concept of volatility. In statistical terms, one measures the average returns and the standard deviation of those observations, which in finance we describe as the level of historical volatility.
This sounds a bit too abstract. Isn't there a way I can translate this into something that I can intuitively understand?
A much better way to think about volatility is to translate the number into a given confidence level for future returns. For example, if an ETF had a 1-year volatility of 21% and a net asset value of 100, then in 1 year's time there would be a 95% probability that the value would lie between 77.5 and 155.5.
Thank you.